Hi there, I'm Mark Anderson. I'm a mortgage banker with Paramount Bank, and although I'm based in St. Louis, Missouri, I'm licensed to lend all around the country in all 50 states. So no matter where you are in the country, I would love to talk to you about a purchase mortgage. If you're looking to get pre-approved, if you're already under contract and you want to see if I can give you a better deal, or if you want to look at a refinance, I'd be glad to help you line up your numbers. We're going to look at things very objectively with a lot of math so that you know precisely what the cost is versus the benefit, etc. Regardless of what your motives are or what you're looking for in the mortgage space, please do call or text me at the number below anytime. So for today's mortgage rate update, I'm going to lead with an admission of guilt. I was wrong. In my last video, I was pointing out the fact that the Federal Reserve was starting to take away some of the policies that were pushing rates down. Now, it wasn't 100% wrong because at the time, these things were happening. The Fed was starting to pull back on some of these policies, and rates did start to incline. However, where I was wrong was with my prediction, which I hedged. This is a market that really defies prediction, and I always say that. But where I was wrong is I said this probably is the beginning of the end of super low rates. And that what we were probably going to see over the next 6 to 12 months was a slow but relatively steady upward trend as far as rates are concerned. That has so far not come to be. In fact, rates today are a little bit lower in general versus where rates were at the time I did that video. Now, the main driver of this is that an organization called the FHFA, the sea of acronyms in this industry is astounding. The FHFA, which is the kind of parent government organization of the pseudo-private, pseudo-government mortgage agencies, Fannie Mae and Freddie Mac, they had instituted something called an adverse market fee. Now, this adverse market fee was put in place to kind of store nuts up for the winter that was going to come from all of the forbearance activity that the agencies were engaged in last year. So forbearances out of Fannie and Freddie borrowers across the country peaked in May of last year at approximately 5% of people holding Fannie or Freddie loans had applied for and were in one of these forbearance programs. That number is now down to about 2%. So for that reason, the FHFA has decided to stop this adverse market fee, and that is actually a very good thing as far as mortgage rates are concerned. Now, one little quibble, I'm going to pick on the financial news industry here for a second because I've already gotten like 4 or 5 calls over the past couple of days. Every one of the articles that I've read on the subject says FHFA announces removal of 0.5% fee for adverse market condition, blah, blah, blah. That does not translate into 0.5% on the mortgage rate that consumers pay. That 0.5% is a fee that is built into the revenue on an individual mortgage asset sale. So when a mortgage company sells a loan, there is a gain on sale that's some percentage of that loan. So out of the overall percentage of revenue on that loan, the FHFA put in 0.5% that had to be paid to them to cover this adverse market fee, which then went into, I guess, some sort of separate bucket to hold for potential losses associated with the forbearance program. So long story short, what this 0.5% fee actually translates into for the consumer in general, and this is kind of, I wouldn't say it's a shot in the dark, but it's hard to be 100% accurate with it. Generally speaking, it represents about 0.125 or 0.25% on the actual interest rate. So for example, using completely made up interest rates just to illustrate the point, let's say that normal market rates at a given time were 5%. The FHFA fee would jack that rate up to 5.125 or 5.25%. So that's how that 0.5% fee ends up getting baked into what the consumer sees. So the FHFA has gotten rid of this adverse market fee. That is a good thing. Another thing that caused rates to go down is the stock market had a little bit of a topsy-turvy day yesterday. Anytime that the stock market does badly, And for this reason, I actually tend to look at the stock market differently than probably your average person, because when the stock market is having a bad day, that is almost always good news for the mortgage bond market. So as stocks go down, bond prices go up, and interest rates therefore tend to go down. So you had the FHFA fee go away. You had the stock market take a little tumble. And then you also had the ever-looming, ever-relevant COVID-19 situation. So from the beginning, I mean, COVID really is, if there's one thing that caused the mortgage interest rates to fall, albeit in kind of a domino effect kind of way, it is COVID. And COVID was making a lot of scary headlines over the past couple of days. And generally speaking, concerns over COVID have led to a reduced interest rate environment overall, and it generally tends to influence the mortgage rates down. So you kind of had a triple whammy over the past couple days. Now, here's where I'm going to get back into prediction mode, and where I'm going to be a little bit cautious. Who knows how long this window of particularly low rates is going to last? I still think, when looking at the fundamentals, over a long enough time horizon, and this is hardly a brave prediction, on a long enough time horizon, these rates are going to have to move up. But I think that the chances of it happening sooner rather than later, like say over the next 3 to 6 months, I still think overall rates are going to go on an upward climb by the end of this year. This most recent dip, I see no reason to believe that it is going to dip further. And I see every reason to believe that one little thing, whether it's a Fed statement that says that they're going to start tapering these mortgage-backed security purchases, whether it's a good jobs report, any good news in the economy is generally speaking going to influence rates to move up. I don't see this window holding for very long. So what I'm going to advise you to do, which I know is a very self-serving thing to say as I am the guy selling mortgages, but if you have not refinanced, take a look. Now could be a very, very good time to do that. If you're looking to purchase a property and you've secured a contract, I wouldn't look a gift horse in the mouth. I would lock in wherever we are at today with your lender, or if you want to give me a shot at earning your business, give me a call. I'll let you know what our rates look like. But this is good news. No indication on how long the window is going to be open, so strike while the iron is hot. If you've enjoyed this content, please do like the video, subscribe to the channel. I'm desperately trying to get my subscriber count up, so please do subscribe to my channel, and also share this with anybody that might find it useful. Thank you so much for watching.